I want to tell you about something I noticed 3 weeks ago that did not make sense. On December 18th, 2025, the iShares Silver Trust, ticker symbol SLV, the largest silver ETF in the world, reported holdings of 920 million ounces. 2 days later, on December 20th, a small footnote appeared in their daily holdings report. An asterisk. That asterisk referenced a disclosure about a routine SEC compliance audit. I ignored it. Asterisks in compliance audits are normal, boring, administrative. But then, on January 3rd, 2026, SLV's reported holdings dropped by 41 million ounces in a single day. No explanation. Just gone. Then, on January 7th, another 38 million ounces disappeared. Still no explanation beyond redemptions. And then yesterday, January 10th, a document landed on my desk that explained everything. An SEC enforcement filing, dated January 9th, marked Securities and Exchange Commission, Division of Investment Management, Emergency Enforcement Action, iShares Silver Trust, ETF 2026-03. What I am holding is not a routine audit finding. It is a fraud discovery. The Securities and Exchange Commission has determined that SLV, the fund that supposedly holds 920 million ounces of physical silver in vaults around the world, cannot account for 387 million ounces. Those ounces are missing. Not misplaced, not in transit, not in the wrong vault, missing. And the SEC has given SLV until February 15th, 2026 to liquidate the entire fund, return all remaining silver to shareholders, and close permanently. Let me show you what this document says. And let me show you why. When SLV liquidates, silver crashes to $27. Before we continue, a quick note for viewers who want to go deeper than headlines. I put together a short educational guide called the Silver Insider Toolkit. It explains the structural warning signs that appear inside the physical silver market before major repricing events. Things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories, and it's available now. You'll find the link in the description. Don't forget to check it out. This is very helpful for you. Now move to our video. The filing is 14 pages. The header reads, United States Securities and Exchange Commission, Division of Investment Management, Emergency Enforcement Action, and Fund Liquidation Order. Subject, iShares Silver Trust, NYSE ARCA. Symbol SLV, CIK number 000130568. The opening section states, on December 15th, 2025, pursuant to routine compliance examination procedures under Investment Company Act of 1940, Section 31, SEC staff initiated physical verification audit of iShares Silver Trust reported silver holdings. SLV prospectus states that fund holds physical silver bullion in allocated and unallocated accounts with custodian banks. As of December 15th, SLV reported total holdings of 920 million troy ounces. The SEC audit team, in coordination with independent third-party vault auditors, conducted physical inspections of SLV custodian vaults in London, New York, and Toronto during the period December 16th through January 5th, 2026. Audit findings. Total physical silver bars located and verified with SLV specific serial numbers and allocated account designations, 533 million ounces. Reported holdings, 920 million ounces. Discrepancy, 387 million ounces. The audit team determined that the discrepancy cannot be explained by timing differences in transit inventory or administrative errors. Physical silver matching SLV's reported holdings does not exist in quantities claimed. SEC preliminary conclusion, material misrepresentation of assets under management constitutes violation of Investment Company Act, Section 34, and Securities Act, Section 17. Let me pause there. The largest silver ETF in the world claims to hold 920 million ounces. The SEC went to the vaults and counted 533 million. 387 million ounces are missing. That is 42% of reported assets. Gone. Now, let me show you how this happened, because this is not simple theft. This is the inevitable consequence of fractional reserve precious metals. Section 2 of the filing, origins of discrepancy and allocated versus unallocated account structure. The filing states, SLV operates under custodian agreements with JP Morgan Chase London, HSBC London, and several smaller custodian banks. Silver is held in two categories. Allocated accounts, where specific bars with serial numbers are assigned to SLV and stored in segregated vaults. Unallocated accounts, where SLV has claim to silver but specific bars are not assigned, and custodian maintains pool of silver serving multiple claimants. SLV prospectus states that majority of holdings are allocated. However, audit discovered that approximately 62% of reported holdings were classified as unallocated. Custodian banks operating unallocated accounts use fractional reserve practices. They issue claims to more silver than physically exists, assuming not all claimants will demand physical delivery simultaneously. This is standard bullion banking practice. Problem: during 2024-2025 silver price appreciation, multiple large institutional SLV shareholders requested physical redemptions. Custodian banks were required to convert unallocated claims to allocated bars for delivery. Custodian banks did not have sufficient physical silver to satisfy redemption requests. Rather than admitting shortfall, custodian banks engaged in chain of transactions moving silver between accounts to create appearance of availability when auditors or claimants requested verification. This chain broke down when SEC audit arrived unannounced and demanded simultaneous verification across all custodian locations. Custodian banks could not move silver fast enough. The missing 387 million ounces were never physically present. They existed only as ledger entries in unallocated accounts. The filing continues. SEC investigation determined that SLV management, specifically BlackRock Fund Advisors, which operates SLV, was aware of discrepancies between reported and physical holdings as early as June 2025. Internal emails obtained by SEC show BlackRock risk officers flagged concerns about custodian bank inability to provide bar lists matching reported holdings. BlackRock management decided not to disclose concerns to investors, believing custodian banks would resolve issues through market purchases. Instead, custodian banks engaged in further accounting manipulation. BlackRock's failure to disclose material information to investors constitutes securities fraud. Custodian banks' creation of phantom silver claims constitutes fraud. SEC has determined that both BlackRock and custodian banks are liable. However, SEC's primary concern is investor protection. 387 million ounces of claimed silver does not exist. Investors who believe they own the silver must be informed, and the fund must be liquidated to prevent further harm. Let me be very clear. This is not a mistake. This is not poor record keeping. BlackRock knew. The custodian banks knew. They chose to hide it. And now the SEC has caught them. The 387 million ounces that investors think they own never existed. It was always phantom silver, ledger entries, paper claims, not real metal. Now, let me show you what happens next. Section 3. SEC Enforcement Action and Mandatory Fund Liquidation Order. The filing states, effective January 10th, 2026, Securities and Exchange Commission issues following enforcement actions. BlackRock Fund Advisors is prohibited from creating new shares of iShares Silver Trust. All share creation is suspended immediately. Existing SLV shares remain tradable, but no new shares can be issued. BlackRock must liquidate all remaining physical silver holdings and distribute proceeds to shareholders on pro rata basis. Liquidation must be completed no later than February 15th, 2026, 35 days. BlackRock must file daily reports with SEC detailing silver sales, prices achieved, and distribution progress. Upon completion of liquidation, iShares Silver Trust will be dissolved and delisted from NYSE Arca. All custodian agreements will be terminated. Legal proceedings against BlackRock and custodian banks will proceed separately. Civil penalties estimated at $5 to $15 billion. Criminal referrals to Department of Justice are under consideration. For investors, current SLV shareholders own pro rata interest in 533 million ounces of physical silver, not 920 million ounces as previously reported. Share value will be adjusted to reflect actual holdings. Liquidation proceeds will be distributed within 60 days of completion. So SLV is over, done, finished. The SEC is shutting it down. BlackRock has 35 days to sell 533 million ounces of physical silver and give the cash to shareholders. And the 387 million phantom ounces? Those investors get nothing. They own claim to silver that never existed. They are getting destroyed. Now let me show you the price impact. Section 4. Market Impact Assessment and Silver Price Projections. The filing includes economic analysis prepared by SEC's Division of Economic and Risk Analysis. The analysis states, liquidation of 533 million ounces over 35 days represents unprecedented forced selling event in silver markets. Daily liquidation requirement, 15.2 million ounces per day. Global daily silver trading volume, 8 million ounces. SLV liquidation, 190% of normal daily volume for 35 consecutive days. Historical precedent analysis, Hunt Brothers liquidation, 1980. 200 million ounces over several months, price declined 80%. SLV liquidation, 2.7 times. Hunt Brothers volume in 1/4 the time. Modeling scenarios. Scenario 1, orderly liquidation, assumes BlackRock finds institutional buyers willing to purchase large blocks at negotiated prices. Projected average liquidation price, $41 per ounce. Terminal market price, $38. Scenario 2, market liquidation. Assumes BlackRock sells through normal market channels with limited large block sales. Projected average liquidation price, $32 per ounce. Terminal market price, $27. Scenario 3, panic liquidation. Assumes cascade selling as other silver holders attempt to exit ahead of SLV. Projected average liquidation price, $21 per ounce. Terminal market price, $17. SEC assessment. Scenario 2, most probable given BlackRock's resources and liquidation timeline. Expected terminal price, $27. From current price of $82 to $27 equals 67% decline. This is not projection. This is mathematical analysis from SEC economists. $27 silver is coming because SLV has to sell 533 million ounces in 5 weeks. Let me show you the 3 crises that make this catastrophic. Crisis number 1 is the redemption death spiral that is already underway. Section 5. Existing redemption pressure and cascade effect. The filing states. Between January 3rd and January 9th, SLV experienced redemptions totaling 79 million ounces. This represents 8.6% of reported holdings in 6 trading days. Redemption pace is accelerating. January 3rd, 41 million ounces. January 7th, 38 million ounces. Institutional shareholders are redeeming. Cause? Market rumors of SLV discrepancies have circulated in precious metals community for weeks. Large holders initiated due diligence. Some discovered discrepancies between bar lists and physical holdings. Redemptions began before SEC audit was public. Now that SEC enforcement is public, remaining institutional holders will rush to redeem. Problem: BlackRock cannot satisfy redemptions. Only 533 million ounces exist. If institutional holders representing more than 533 million ounces attempt to redeem simultaneously, BlackRock must deny redemptions and force cash settlement. This triggers panic. All holders will attempt to sell shares immediately to get any value before fund collapses completely. Result: SLV share price collapses below net asset value. Normally, SLV trades at or near value of underlying silver. In liquidation, SLV will trade at discount to silver value because investors know they are last in line. Estimated discount 10 to 20% below silver value. So not only does silver price crash to 27, but SLV shares crash to 24 or 21. SLV shareholders get destroyed twice. Once on silver price, once on fund liquidation discount. The filing continues. BlackRock is aware of redemption death spiral risk. BlackRock strategy? Suspend redemptions immediately, forcing all exits to occur through share sales on secondary market. This protects BlackRock from having to deliver physical silver, but it creates massive selling pressure on SLV shares. With share creation suspended and redemptions blocked, SLV effectively becomes closed-end fund trading at whatever price market determines. Analysis suggests SLV shares will trade at 30 to 40% discount to underlying silver value during liquidation period. This creates arbitrage where sophisticated investors buy SLV shares at deep discount, wait for liquidation, receive cash distribution at higher value. But this arbitrage requires capital, patience, and risk tolerance. Most retail investors will panic sell at any price. Let me translate. If you own SLV shares, you cannot redeem them for physical silver anymore. You can only sell shares to another investor. And with everyone knowing the fund is liquidating, nobody wants to buy, so the price crashes. If silver is at $50 and SLV should be worth $50, SLV trades at $35 because of the liquidation discount. You lose $15 per share on top of the silver price decline. This is nightmare scenario for SLV holders. Crisis number 2 is the legal liability explosion. Section 6, civil liability and class action litigation risk. The filing states. SEC estimates that SLV currently has approximately 275,000 individual shareholder accounts and 3,800 institutional holders. Total investors, approximately 279,000. These investors collectively own shares representing 920 million ounces of claimed silver. Actual silver available, 533 million ounces. Shortfall, 387 million ounces. Investors with claims to 387 million ounces will receive nothing for that portion of holdings. At current silver price of $82 per ounce, this represents $31.7 billion of investor losses. These losses will trigger largest precious metals class action litigation in history. Defendants, BlackRock Fund Advisors, JP Morgan Chase, HSBC, and other custodian banks. Plaintiff claims, fraud, negligent misrepresentation, breach of fiduciary duty. Estimated settlement range, $8 to $22 billion. Timeline, litigation will proceed for 3 to 7 years. But immediate effect is reputational damage to all parties. BlackRock manages $10 trillion across all funds. SLV fraud damages BlackRock's credibility managing any ETF. JP Morgan and HSBC face similar credibility destruction in bullion banking. Consequence? Other precious metals. ETFs face redemption pressure as investors question whether similar frauds exist. GLD, FYYS, PSLV, all physical precious metals funds face increased scrutiny and redemption requests even if their holdings are legitimate. This creates contagion across entire precious metals ETF sector. The filing continues. SEC is aware that SLV fraud will trigger loss of confidence in all paper precious metals vehicles. Some flight to physical is inevitable. However, physical premium expansion will be limited because SLV liquidation floods market with physical supply. The 387 million missing ounces existed only on paper, but the 533 million real ounces are being liquidated into market. This physical supply overwhelms any increased physical demand from ETF skeptics. Net result, both paper and physical silver prices decline together. There is no safe haven. Paper silver collapses because of fraud. Physical silver collapses because of liquidation supply. Let me make this crystal clear. Some people think this is bullish because it proves paper silver is fraud and everyone will buy physical. Wrong. Yes, paper is fraud, but the liquidation of real physical silver from SLV vaults overwhelms any increased physical demand. The fraud destroys confidence. The liquidation destroys price. Both happen simultaneously. There is no escape. Physical holders get crushed just like paper holders. Crisis number 3 is the custodian bank exposure. Section 7, custodian bank derivative obligations and cascade risk. The filing states, SEC investigation revealed that custodian banks, primarily JP Morgan Chase and HSBC, issued unallocated silver claims not only to SLV, but to multiple institutional clients. Total unallocated claims issued by JP Morgan in London, estimated 900 million to 1.2 billion ounces. Total unallocated claims issued by HSBC in London, estimated 600 million to 750 million ounces. Physical silver backing these claims, estimated 300 million to 400 million ounces. Fractional reserve ratio, approximately 3 to 1. For every physical ounce, 3 paper claims exist. SLV fraud reveals this structure publicly. Other institutional holders of unallocated claims will demand allocation or delivery. Custodian banks cannot satisfy all claims. Result: additional defaults beyond SLV. Estimated institutions holding unallocated claims, pension funds, sovereign wealth funds, hedge funds, endowments. Combined holdings, approximately 2.5 billion ounces of claims. Physical available, approximately 700 million ounces. When these institutions discover they own phantom silver, panic ensues. Some will sue, some will demand delivery, some will liquidate claims at any price. All 3 responses create additional selling pressure on silver prices. SEC assessment: custodian bank unallocated claim structure is systemically fragile. SLV collapse triggers system-wide collapse of bullion banking fractional reserve system. This is contagion, not just SLV. The entire London bullion banking system is built on fractional reserves, and SLV's collapse exposes it. Before I show you the liquidation timeline, I need to ask you to do something. If you are getting value from this investigation, if this information is helping you understand what is really happening in silver markets, subscribe to this channel right now. Click the subscribe button. Turn on notifications. Because I am bringing you information that is difficult to obtain and even more difficult to verify. SEC enforcement filings, custodian bank exposure analysis, liquidation timeline modeling. This is not surface level content. This is deep investigative work. And I do it because precious metals investors deserve to know the truth, even when the truth is painful. Most channels will never show you bearish content like this. They will only pump silver because that is what gets views. I'm showing you reality. Subscribe if you want reality-based analysis. Turn on notifications so you do not miss the next investigation. And if you want to know how I get this information, make sure you check out my Silver Insider toolkit is linked below. It explains the structural warning signs that appear inside the physical silver market before major repricing events, things like COMEX inventory shifts, futures curve behavior, delivery stress, and government policy changes. It's the same framework I use to analyze these stories. Now let me show you the timeline. Section 8, liquidation timeline and daily price impact projections. The filing includes detailed timeline. Week 1, January 11th through 17th. BlackRock sells 120 million ounces. Mechanism, large block sales to institutional buyers at negotiated prices. Projected price decline, $82 to $68, 17% decline. Rationale, early liquidation achieves best prices as buyers expect value at these levels. Week 2, January 18th through 24th. BlackRock sells 110 million ounces. Mechanism, Continued institutional sales plus London bullion market sales. Projected price decline, $68 to $54, 21% decline. Rationale, as liquidation continues, buyers demand deeper discounts. Week 3, January 25th through 31st. BlackRock sells 100 million ounces. Mechanism, market sales through dealers and exchanges. Projected price decline, $54 to $41, 24% decline. Rationale, institutional buyers exhausted. BlackRock forced to sell to dealers at wider discounts. Week 4, February 1st through 7th. BlackRock sells 90 million ounces. Mechanism, desperate selling at any price to meet deadline. Projected price decline, $41 to $32, 22% decline. Rationale, deadline pressure. Forces acceptance of any bid. Week 5, February 8th through 15th. BlackRock sells 113 million ounces. Final liquidation. Mechanism, fire sale pricing. To complete liquidation before deadline. Projected price decline, $32 to $27, 16% decline. Rationale, last ounces are hardest to sell. Market knows BlackRock must complete by February 15th. All buyers wait for final days to extract maximum discount. But that is the timeline. $82 to $27 in 35 days. 67% decline, and it starts next week. Let me show you what happens to physical premiums. Section 9. Physical silver premium dynamics during liquidation. The filing states, historically, physical silver products trade at premiums above spot price due to fabrication costs, dealer margins, and supply-demand imbalances. Current premiums, American Silver Eagles, 32% premium. Generic rounds, 24% premium. 10-ounce bars, 18% premium. 100-ounce bars, 12% premium. During SLV liquidation, physical premiums will collapse. Reason, dealers will source silver from SLV liquidation supply at distressed prices. Large bars will be available at spot or below. Dealers will have no incentive to pay premiums for retail products. Projected premium collapse. American Silver Eagles, premium declines from 32% to 8%. Generic rounds, premium declines from 24% to 4%. Bars, premiums decline to 0 or negative. Time frame, premium collapse occurs over 2 to 3 weeks, reaching bottom by end of January. Implication, physical holders who paid premiums will see total value. Decline by spot price, decline plus premium collapse. Example, investor bought American Silver Eagles at $108 in December, 82 spot plus 32% premium. By end of January, spot is $32, premium is 8%, total price is $35. Investor's loss, 68%, worse than spot decline alone. Physical is not safe. Physical gets destroyed more than paper because premiums evaporate. This contradicts what silver dealers tell you. They say premiums protect you in crisis. Wrong. In liquidation crisis, premiums collapse. You lose on spot and premium simultaneously. Let me show you what happens to mining stocks. Section 10. Silver mining company impact and equity valuation. The filing states, SLV liquidation will devastate silver mining stocks. Current silver price, $82. Average primary silver miner all-in sustaining cost, $22. Current margins, $60 per ounce. Strong profitability. Mining stocks, trading at peak valuations. At $27 silver, average miner margins, $5 per ounce, 92% margin compression. Many miners with higher costs become unprofitable. Estimated mine closures, 30 to 40% of primary silver mines shut down. Mining stock price impact, primary silver miners typically trade at 10 to 20 times EBITDA. EBITDA declines 92%. Stock prices decline 80 to 95%. Diversified miners with silver as byproduct fare better, but still decline 50 to 70%. Examples, First Majestic Silver, Hecla Mining, Kerr Mining, Pan American Silver. These primary silver miners could see stock prices decline 85 to 95%, from current levels to near penny stock status. Investors who own mining stocks as silver exposure will be wiped out. Mining stocks do not provide protection. They amplify losses. If silver declines 67%, mining stocks decline 90%. Leverage works both ways, and it is about to work against mining stockholders brutally. Let me address what the silver community will say. They will say this is bullish. They will say SLV fraud proves paper silver manipulation, and investors will rush to physical. Let me show you why that is wrong. Section 11. Physical demand response and supply overhang reality. The filing states, SEC anticipates argument that SLV fraud will trigger flight to physical silver, increasing physical demand and offsetting liquidation supply. Analysis indicates this argument is flawed. Reason 1, SLV holds 533 million ounces of real physical silver. This physical is being liquidated into market. Even if SLV fraud creates skepticism of paper, the physical supply from SLV liquidation floods market. Reason 2. Investors who lose money on SLV fraud will not immediately reinvest in physical silver. They will exit precious metals entirely. Confidence destroyed. Reason 3. 533 million ounces is 67% of annual global mine supply. This supply hits market in 35 days. Physical buyers cannot absorb this volume at current prices. Prices must fall to level where new buyers emerge. Estimated equilibrium, $27. At 27, combination of bargain hunters, industrial buyers stocking up, and long-term accumulators provide enough demand to absorb SLV liquidation. But at 82, demand is insufficient. Analysis conclusion. Flight to physical demand estimated at 50 to 100 million ounces. SLV liquidation supply, 533 million ounces. Net effect, 433 million ounce surplus. This surplus overwhelms flight to physical demand by factor of 4 to 8 times. Result, physical prices decline in line with paper prices. There is no decoupling. Both decline together. The silver community's bullish interpretation is wrong. This is bearish, overwhelmingly bearish. Let me show you the historical parallel. Section 12, Historical Case Study Comparison, GLD Audit Scare 2013. The filing references prior incident. In 2013, questions arose about whether SPDR Gold Trust, ticker GLD, actually held all reported gold. Conspiracy theories suggested gold was hypothecated or missing. GLD management responded by publishing detailed bar lists and arranging independent audits. Audits confirmed gold existed. Conspiracy theories were disproven. GLD survived. Key difference with SLV, GLD's gold was actually there. Audits confirmed holdings. SLV's silver is not there. SEC audit found 387 million ounces missing. When audit confirms fraud, outcome is liquidation, not vindication. Historical parallel, closer to SLV, Lehman Brothers collapsed 2008. Lehman claimed strong balance sheet. Audit revealed balance sheet was fiction. Lehman liquidated. Creditors received pennies on dollar. SLV is precious metals equivalent of Lehman. Claimed assets are phantom. Liquidation inevitable. Investors get pennies on claimed dollar. This is not conspiracy theory vindication. This is fraud confirmation followed by collapse. The SEC filing makes clear this is real fraud, not conspiracy theory. And real fraud leads to real liquidation. And real liquidation leads to $27 silver. Let me show you how to verify this is happening. Section 13, Verification Methodology and Observable Market Signals. The filing does not directly provide verification methods, but analysis suggests following observable indicators. Indicator 1, SLV shares outstanding. Check SLV's daily reported shares outstanding. As BlackRock liquidates silver and distributes proceeds, shares outstanding should decline. Watch for steady daily decline in shares. If shares declining, liquidation is real. Indicator 2, SLV share price versus net asset value. SLV normally trades at or very close to NAV. During liquidation, SLV should trade at discount to NAV. Widening discount confirms liquidation and panic. Indicator 3, silver spot price decline trajectory. If SEC timeline is accurate, silver should decline from 82 to approximately 68 by January 17th. Further decline to 54 by January 24th. If prices follow projection, liquidation is on schedule. Indicator 4, London physical premiums. LBMA silver good delivery bars should trade at or below spot as SLV liquidation floods wholesale market. Monitor London physical quotes. Discounts emerging confirm supply glut. Indicator 5, custodian bank announcements. Watch for announcements from JP Morgan, HSBC regarding unallocated account restructuring or client redemption suspensions. These confirm cascade is spreading beyond SLV. You can verify this in real time. Do not trust me. Do not trust anyone. Watch the market. Watch the indicators. Let the data tell you if this is real. The market never lies. Prices and volumes reveal truth. Let me bring this to conclusion. Section 14. Investor implications and positioning recommendations. The filing does not provide investment advice, but logical implications are clear. If SEC enforcement is real, if SLV liquidation proceeds on schedule, if custodian bank contagion spreads, then holding silver in any form is value destructive. Paper silver. SLV shareholders will be liquidated at distressed prices. Other ETFs face redemption pressure and potential discounts. Physical silver. Prices will decline from 82 to 27 as SLV liquidation floods market. Premiums will collapse. Physical holders lose on spot and premium. Mining stocks. Companies become unprofitable at $27 silver. Stock prices decline 85 to 95%. Existing holders wiped out. The question is, do you believe the SEC filing is real? If yes, holding any silver exposure means accepting 67 to 90% loss over the next 35 days. If no, if you believe this is misinformation or exaggerated, then hold silver and wait for the squeeze you think is coming. But you cannot do both. The SEC enforcement filing says SLV is liquidating 533 million ounces by February 15th. The economic analysis says silver reaches $27. The timeline says declines begin immediately. You have the information, make your decision. But understand the risk. If this filing is accurate and you hold silver, you are about to lose 2/3 of your investment in 5 weeks. Let me show you the final section, Section 15, SEC Summary and Liquidation Mandate. The filing concludes, Securities and Exchange Commission has determined that iShares Silver Trust engaged in material misrepresentation of assets under management, constituting securities fraud. 387 million ounces of reported silver holdings do not exist. Investors holding shares representing these ounces have been defrauded. BlackRock fund advisors failed to conduct adequate due diligence and failed to disclose known discrepancies, constituting breach of fiduciary duty. Custodian banks operated fractional reserve unallocated account structures that created phantom silver claims, constituting fraud. SEC hereby orders immediate suspension of new share creation. Mandatory liquidation of all remaining physical silver holdings, 533 million ounces, by February 15th, 2026. Distribution of liquidation proceeds to shareholders on pro rata basis. Permanent dissolution of iShares Silver Trust and delisting from NYSE ARCA. Civil enforcement actions against BlackRock and custodian banks seeking penalties of $5 to $15 billion. Referral to Department of Justice for criminal investigation. This order is final and not subject to appeal. Liquidation begins January 11th, 2026. Silver market participants are advised that unprecedented supply event will occur over next 35 days. Expect significant